All right. Day 80. And we have a guest of a special and different kind today, who is Connor Sen. We are not going to be giving advice, even though he is now registered to give you investment advice because his firm, Peachtree Creek, is an RIA. And so he's been a founder of his own investment firm, but also something we talk about here is making your career a portfolio of activities. He's a Bloomberg Opinion contributor, which is how we first got to know each other. And he's been active on Twitter. So, by the way, social media can be a resume. There's another thing. He also just told me he got the Bloomberg thing had been reached out to through LinkedIn. So don't hit delete on all the things in your LinkedIn inbox. But this week we're talking about how we think as investors and as founders. And so this question kind of gets to the heart of it, which is kind of, you've been an investor in public market settings, and my guess is in some other things as well. And now you're the founder of a company, and you had said these are very different modes of thinking. And founders often have to think, how would an investor think about this? An investor often has to get in the head of management. So I would just love to hear, how are those different ways of thinking?
I think given my career in public markets as an investor, and I've done a few private things as well, you think about what can go wrong. Right. It's sort of like if the economy slows and the housing market turns down, that might be bad for that. Or my tech stock misses earnings and it gets re-rated multiple wise. Maybe there's fraud or there's some crazy thing like that. And so you're very sort of this negative mindset, or at least you always want to know what are all the negative things that could go wrong for this. But what I found as a founder is that when you take that mindset into starting your business and you're thinking, again, bring that mentality of, okay, I've got to talk to lawyers to get registered and I need insurance and I need this and I need that. And then you actually tell people, hey, I started a company, I'm starting a company. And they're just like, congrats, that's so exciting. And at first you think, wow, everybody else is more excited about this than I am. And it starts to make you understand now the sort of the power of positive thinking and all that coaching that goes into that small business owners really love, the Tony Robbins type of idea, because you kind of do need that positivity when you're starting a company. And I think as an investor, you don't appreciate that. Yeah,
one of the ways that I've put it is, school is in some ways more like the investor mindset, because you get like 100 questions and get them all right. Like don't introduce any flaws, basically.
Right.
Whereas starting a company, it's like there are infinite number of questions. You couldn't possibly address them all, really, which as an investor, you can't really either. But the important thing is to pick the one thing that actually matters. And by the way, there's a myth, I think founders tend to be more positive and optimistic as people, but I've met some pretty down, skeptical pessimists who manage to succeed as well. The thing that I think positivity allows you to do is pick a few things that really matter and just be proud of making them great. And, one of the things that raises for me that I'm curious about is you're often in the position as an investor of talking to somebody who's the leader of a company, who may be in that Tony Robbins mentality. And what do you wish they understood about how you think as an investor? Like if you could download thoughts or perspectives into their brain, what do you wish they might think about?
I think really understanding every company probably has a unique investor base that's optimally suited for that company. So I guess taking two companies on the opposite end of the spectrum, a company like Tesla, which is very almost messianic of, believing in this mythical figure who's going to create the future.
Messiah. He is not almost.
Yeah. And then I guess to go to the other end of the spectrum, a cigarette company where it's like we're selling death, on a stick. And as an investor, you're just like, just pay me the dividends and buy back the stock. And I know you're doing a terrible thing, but I'm just taking this money. It's really just a very, transaction like that. And so most companies fall somewhere in between. And it's up to a CEO or an executive to know, why do people own my stock? Is it for growth? Is it for dividends, for buybacks? And if you have a mismatch, you get a lot of problems.
Yeah. The one way I've heard that characterized is that finding your investors is a search problem, not a sell problem. That a lot of people, and I think this in general is true in business, like a lot of people are in the mentality of, if you're here in this space with me, I'm going to convince you of what I believe. And right. Where many of the most successful people I see, actually they're in the business of disqualifying in sales language, which is to say they're talking to you. The first thing they're thinking is, should I be having this conversation? How do I convince myself this conversation is not worth my time as quickly as possible so I can move on and have conversations with the people who should be? So, but I think your point about there's kind of a natural approach that is wedded to any company is a really good one, and that there are investors who follow that approach. So,
and I think you often see the biggest issues when companies transition from one phase of a life cycle to a new one.
Interesting, yeah.
So like new IPOs often just are really bad at this, and so I had a bad experience with Zillow, which I owned, I guess, 8 or 9 years ago at this point. And it sort of was like, okay, I'm bullish on housing. Here's the tech stock that lets you look at prices, and the stock seemed pretty cheap because people were pretty skeptical of IPOs at that point. And there was one quarter where they did this acquisition of an apartment rental company, and that apartment rental company was a decent share of the revenue for advertising. And so in their earnings report, they said, oh, well, we missed revenue because we bought this company. And so, of course, they're not paying us money anymore because we own it. And then, an investor just says, oh, they missed revenue, and the stock went down like 20%.
Right. They just
and it was,
didn't
probably
get how people thought.
Yeah. As a private company, you're just like, well, we're just building the future. No big deal. A public company is just, you missed earnings.
Yeah. I think that the COVID has been interesting in that, because there's been so much missed that for all the people who are like, oh, the market is so short-term oriented. It's like, well, wait a minute. If the market were short-term oriented, something different would have happened in the last few months. And my takeaway is that it's sometimes short-term oriented and it's sometimes long-term oriented, and it's more around surprise. And what counts as surprise to you is different depending on your standing. So like if you're an early stage company versus not, and the anecdote it brings up for me, and then I'll shut up, is we hosted a session once for the CFOs of late stage private companies, late stage in a venture context, meaning they were not yet public. And they were on their way there maybe. And we hosted this session with a bunch of investors. And the idea was, hey, learn how the people who will hold your stock will think about you. And one of the investors, this was maybe in like 2016 or something like that. One of the investors said, we love early stage companies. I mean, I've held Square shares for the last year. And everybody in the room was like, Square's not an early stage company, is it? But the point is that from the perspective of this investor, of course they were. And from the perspective of what they might be one day, of course they are. And so that, like, bringing different perspectives together, I definitely think is one of these things that a little bit of that can go such a long way to understanding how to run your professional life. So thank you for giving us that contrast, because there's not a lot of founders who have also been investors, and certainly not, it happens in venture a bunch, but being a VC is also very different from being a public market investor. So thank you for that. And we'll be back tomorrow. And Connor, I hope that you'll join us again, not giving people advice, even if you are qualified to do so in your core business. And Min will be back soon too. She's still with us here in the background. So thanks, everybody.
Thanks, Roy.